Ultimate Intermediate Indicator Trading Course, Lesson 8. This video will demonstrate how indicators should be used to have the best performance in your trading setup. New traders complain a lot about having lots of failed trades and lose lots of money. Indicator by itself is not really an evil if you know the purpose and functioning behind it. Traders use too many indicators in their price chart without having any valid reason or purposes. This way they lose money for purchasing an expensive one and having failed trade at the same time. This video will show you how you use them correctly through some practical examples to clarify the trading strategy. What is the most common trader's opinion about indicator? I asked so many traders' opinion and they claim after they pay so much money for an expensive indicator and having lots of failed trades, finally they got fed up. Their reason about indicator was it is expensive to buy, it lags the market, it cannot predict what the market will do next, it gives false signals, and also it gives late entries. As a professional in this field, traders do not want to know the reason why they lose money all the time. Indicator by itself is not an evil, as I mentioned before. It cannot predict what the market will do next. It cannot make the decision for you. It can only help your decision-making process. This video will show you lots of examples to clarify the trading strategy behind it. What is a technical indicator? First, we have to know the definition of an indicator. Trading indicators are mathematical calculations which are plotted as lines on your chart in order to identify certain signals and trends within the market. What is the role or purpose of indicator in your trading? Indicators simply show traders what have happened during the past trading period and will never tell you what will happen in future. If you know what will happen in future, everybody become a millionaire. Because let's say if you know the trend is going to go up for another 2 months from now, so everybody participate and they make money. Traders believe if you buy the most expensive indicator or you put the right combination, they will become rich. But after a few failed attempts, they wondered why it doesn't work. No matter how many different combinations you use, if you solely rely on indicator to make decision for you, it will never be profitable. Indicator instead will improve and help your decision-making process. Therefore, your concept about indicators should be revised. Professionals use different indicators for different market conditions and purposes. Technical indicators generally fit into these 5 different categories. The first one is trend indicator, which is lagging indicator. It analyzes the market movement, whether it's going upward, downward, or sideways. The second one is relative strength index, which is a leading indicator. It is a momentum oscillator that measures the speed and change of price movements. The third one is volume indicator, which could be leading or lagging indicator. Volume indicator is used to measure the relative significance of the market move. The higher the volume during the price move, the more significant the move is. Or the lower the volume during the price move, the less significant the move is. The fourth one is momentum indicator, like MACD indicator. Although MACD is a lagging indicator, when trading on the crossover, it is more of a leading indicator when it is used to highlight possible overbought or oversold conditions. A leading indicator is useful because it alerts you to what price may do in the future. And finally, the last one is mean reversion indicator, like Bollinger Band. Using the band as overbought, oversold indicators rely on the concept of mean reversion of the price. Bollinger Band identify asset prices that have deviated from the mean. In range bound markets, mean reversion strategies can work well as prices travel between the two bands. What is lagging or leading indicator? A lagging indicator is a tool that gives signal once the price movement has already started. Lagging indicator can be more accurate, but this is because they are far slower to react. Lagging indicators are drawn onto the price chart itself and include moving averages, the MACD, and Bollinger Band indicators. A leading indicator is a tool designed to anticipate and predict the future price direction of the market. Leading indicators react to the prices quickly and is more susceptible to false signals. A lot of popular leading indicators fall into category of oscillators, including the RSI, Relative Strength Index, stochastic oscillator, Williams R percentage, and OBV on balance volume. How indicators can be used correctly in trading? Trading indicator is designed to serve certain tasks and purposes, and the only way to know its purpose is to understand the math and logic behind it. I do not say that you have to be a mathematician to understand indicators, but at least you have to know the theory behind indicator in order to be able to understand it. Indicators serve in three broad functions. The first one is to alert. An indicator can act as an alert to study price action a little more closely. The second one is to confirm. Indicators can be used to confirm other technical analysis tools. And finally, to predict. Indicators can be used to predict the direction of future prices. We can also generalize the purpose of indicators as to filter out market conditions, to identify area of values, to time your entries, and finally to manage your stop loss. These are the main tasks of indicator, and I am going to explain clearly in my few next slide. Don't make these trading mistakes. This is the price trend Bombardier stock D1 time frame. I installed a stochastic indicator with 14 days period and also RSI with 14 days period too. I want to tell you, do not make the mistakes that beginners make in their trading setup, and they have the most failed trade. They install 2 or more indicators from the same group. Now what happened? If one have shown false signal, then all show the same thing, and you think it is correct because they are all in line and they confirm each other. Therefore, you go ahead with your trade and result in a failed trade and lose money. Look at this example here. Now, The trend here is at the top of an uptrend, and look at here, that is stochastic shows in overbought. Same thing in RSI shows very strong uptrend, very strong momentum here. Now, these two, they're showing the same thing because they're the same group, from the same group, like CCI, they're from the same group. Now, look at this stochastic here and RSI. Both show the same direction. Same direction. Because the value of these two is calculated using the same formula, and they confirm each other, not because the signal is strong, because they are from the same group. Look at another example. This one, the price is going up here, and look at the stochastic is in overbought, and look at RSI. Same thing, showing very strong because they're from the same group. Look at another example. The price is in at the bottom of a downtrend here. It shows at the bottom of downtrend. And look at the stochastic is in oversold area. Look at RSI is on oversold area. So both of them, they're in line and show the same thing. Another example. This is, again, the prices showing going up at the top of an uptrend. Look at the stochastic. It showed the same thing, and RSI showed the same thing. Now, my argument is, what happens if a stochastic show a false signal? Then RSI does the same thing, and you think that they're in line and they confirm each other. So you go ahead with your trade. And then you end up you end up a failed trade and lose money. Now, the second mistake that you should avoid, never copy indicator from somebody else, because the trading strategy and purpose may be completely different from yours. So maybe for him RSI is good, but for you is not. Maybe for him stochastic is good, but for you maybe the right one is moving averages. So never copy indicator from somebody else without knowing the purpose. The first purpose of an indicator is to filter out market condition. This is the price trend, Air Canada stock, and D1 time frame. I installed simple moving average with 50 days period, and also I installed unbalanced volume in order to show you how to filter out market condition. Now look at the imbalanced volume here. It shows in this part that the volume basically is unchanged, and then it going upward and just a little bit downward and become flat. And look at the moving average. Moving average, it shows flat, same thing as here, and again the price is above the moving average till this part, so that's a sign of an uptrend. So here the volume increases, and then here we have a sign of an uptrend, a strong uptrend. Then we have just a little bit downtrend, and that's the reason we have here a little downtrend here. And finally the price become flat, and unbalanced volume shows flat too as well. And again, after the unbalanced volume shows increase in volume, and then decrease in volume and increase in volume. And look at what happened is to simple moving average with 50 days period. Here we have an increase in uptrend. The price is above the moving average, showing strong uptrend, and then it goes down. We have a downtrend, so it's decrease in volume. That's decrease in volume, and then again uptrend, increase in volume. Now, moving average is a multi-purpose indicator that can show you how filter out market condition. It can indicate where the trend is upward, here, upward, downward, or sideways. It means if you filter out the market condition, you know where you have the best chance to have a win trade. On balance volume does the same job. Here it does the same job. So here the purpose of having moving average or unbalanced volume is to highlight where the trend is upward, downward, or sideways. Therefore, there is a purpose to have indicator, but we do not need to have them both, since both does the same job. One is enough. I do not want to overcrowd my chart. The second purpose of an indicator is to show areas of value. This is the price trend, ERF stock, D1 time frame. I installed simple moving average with 50 days period as dynamic support. I also install MACD indicator with 12.26.9 parameter, and I'm going to show you that I use this indicator to show you the area of value too as well. Now, the first purpose of this moving average indicator was to filter out market condition, and the second purpose of this indicator to identify the area of value. We use moving average SMA 50 as multi-purpose indicator to use as dynamic support and resistance level. There are areas that we have price rejection and also price breakout and or price breakdown. This is the price rejection, the price coming to the market structure, and it gets rejected by the support, by dynamic support. The same thing here, the price coming to the market structure and again rejected by dynamic support. And here the price break down the support, the dynamic support, and again here the price break out the resistant, the dynamic resistant. So we can also use trend line, wedges, triangle, channel, Fibonacci as to identify the area values. Then we can also use RSI, Bollinger Band, a stochastic indicator, and use the overbought and oversold area as area of value and entry setup. Now, MACD indicator is also good to use the area of value. You can see here the blue line crosses the orange line while going upward. That is the place that you can enter the market, and this is the area of value that you can set up your entry place. You see the length of a histogram bar, the green one, it's increasing all the way here, so that is the sign of a strong uptrend. And you see here, that's a strong uptrend all the way here, so you can use. And the price rejection from here, you see the price is coming down, going downward, as you see the histogram bar shows, and from here the price increase all the way here, and you see the length of a histogram bar, the green bars on the negative side, it becomes shorter. That's a sign of an uptrend on the negative side. And on a positive side, it becomes zero here, and on positive side, it increased the length. So that is the sign of an uptrend. So these are considered as area of value, and the same thing for here. So you see, indicator is only good if you know the purpose. Please do not use more than one indicator from the same group, since it will be redundant and your chart will be crowded. The third purpose of an indicator is to time your entry. This is the price trend, Apple stock, and D1 time frame. This is Apple stock, and that is D1 time frame. Now I installed MACD indicator with 12.26.9 parameter. You see from here the trend is coming down all the way to this bearish candle, and you can see it from the MACD indicator. The blue line is below the orange line. That's considered as a downtrend. And from here, from this bearish candle right there, you see the length of a histogram bar here. The green one is getting shorter on the negative side, and getting, after that, it becoming zero and going up on the positive side. That's the sign of an uptrend. And this uptrend after that continue all the way to this place. Now this period is between March to April 2021, and you bear in mind that from March almost 9 till March 17, you see the trend is upward. You see this trend is upward. And then after that it continues all the way. Now, in order to enter the trade, we have to go to one step lower time frame. This is D1 time frame, and you have to go to one step lower time frame, which is H1, in order to find the precise location where we can enter the market between these two periods, like March 9 and March 17. Time your entry, continue. This is the same Apple stock and H1 time frame. I also installed the same MACD indicator with 12.26.9 parameter. Now here I mentioned March 9 till March 17. In this period the trend was upward, as you could see it. Now this is a blue line crossing the orange line while going upward. That's a sign of an uptrend. Here you see that the length of a green histogram bar is increasing. It decreases just a bit and again increase, and again here it increase again all the way here. So that is basically a nice uptrend that you can enter the market. So you can enter the market right here, and here indicator help you that if you have any doubt with the candlestick that is too short, that's too big, whether that's engulfing, whether that is the hammer, whether the body of the hammer is too small or too big, and so on. Here the MACD indicator help you to overcome that complication. So you get help from indicator, and it help your decision making process. And this is your strong reason and purposes of using MACD indicator to find your entry trigger. Use dynamic trend line and ATR indicator to manage your stop loss. This is the price trend Apple stock D1 time frame. I also installed ATR indicator in order to read the ATR value for calculating the stop loss. Now I also draw my dynamic trend line as act as a support area, and you see that this dynamic trend line has considerable touches, that it considered as a valid dynamic support. And we have a price rejection here, we have price rejection here, and we have price rejection all around here. The price is coming to the market structure, and also it got rejected by dynamic support. So here, that's the best area that you enter the market. Now in order to enter the market, for example here, now you have to calculate the ATR below and put your ATR 1 or 2 ATR below the support area. How you calculate the ATR? Just like this, you draw a vertical line from this point all the way down, until they intersect the ATR curve, and then you go horizontal and you read the value of ATR for that particular point. Now the ATR value is $4.50. Now you put 2 ATR, which is about $9, below the support area. That's how you use dynamic trend line and also ATR indicator to manage your stop loss. Use MACD indicator and ATR value to manage your stop loss. This is the price trend, Apple stock and D1 time frame. I installed MACD indicator with 12.26.9 parameter, and that is the MACD indicator. And also I installed ATR indicator with 14 days period to calculate the value of ATR for the stop loss. Now you see here this strong downtrend, and that's the bottom of a downtrend, and that's a very good place that you can enter the market. And if you come down here, you see MACD indicator, the blue line crosses the orange line while going upward, so that's a very good place to enter the market. And so the only thing is you have to calculate the ATR value around here, in order that when you put your entry here, then you put 1 or 2 ATR below the entry price. Now how you calculate the ATR value? It's very simple. You draw the vertical line like this from the bottom of a downtrend here, and it comes that it crosses, it caught the cross line of MACD indicator, and it come down and it caught the ATR curve, and you go horizontally in order to find the value of ATR. So the value of ATR is $15. Now if you put your entry price here, then you put 2 ATR below the entry price, and you are set. That's how you use MACD indicator and also ATR indicator to manage your stop loss. That's all, folks. If you like this video, thumbs up and subscribe. Thanks for watching. Take care and see you next time.